Hello, everybody. I would like to talk today about the application of a Black-Scholes or option pricing methodology to value companies. Uh, why using option pricing methodology to value companies? Because especially in in startup companies, in early stage enterprises, we have very complex equity structure. In order to obtain the financing, the owner of the startup has to provide different rights to potential investors in order to make this more interesting for the investors to participate in his venture. So because then different investors can have different rights, they will participate differently in the equity or in the value of the company. This provides a difficulties as when we would like to value this different investment. And here is the area when Black-Scholes or the option pricing is something which can help very much in the valuation. Okay, so I will try to provide some insight and explain why the option price methodology or the OPM Backsolve is a game changer. Um, when we are valuing an early stage enterprises, it is like navigating a complex maze. We have different classes of equity with different rights and this has to result in the valuation. So what kind of rights this classes can have? Okay, especially let's talk about the most important one: liquidation preference, participation rights, and conversion rights. What is liquidation preference? When somebody invests money in the startup, it wants to have the equity share, but at first he wants to be sure that in case if the investment is not running as good as everybody expected or hoped for, that he will at least get something back. So he has the right that the first 2 million or 1 million of the company assets or of the profits of the company of the equity will belong to him. So he will be the first to pay it off. It is not important when the company is successful like Microsoft or any other big company, but if the startup is not successful, so the first million sometimes is all what the company has. So this liquidation preference offers you a very important right. But then it has to be, it has different, if somebody has this value has the, if somebody has this right has the different value than the regular share of capital. Second, participation rights. If somebody invested in the company and has liquidation preference, but also it can be interested to say, okay, at least I would like to have some dividends, even if you don't pay, but in the future you can pay this cumulatively back to me. So I want to participate in case of the future profit, or in case of the future profit distribution. And then at some point, the most interesting thing it is to have shareholding in the company. So I want to convert my investment into I want to convert my investment into shares of the company, the equity capital. So having these different rights, we have to treat these rights differently when we want to value them. And in order to value these rights, we can use so-called waterfall methodology. Waterfall means the profit or equity is treated like a waterfall. somebody who is at the end of the beginning of the waterfall will get the most of it, and then the waterfall is getting smaller, and then everybody the further away you are from the beginning, the less you can get. So in principle, in order to 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 replicate this waterfall, we create different breakpoints. In option terms, the breakpoints are nothing else as strike prices. And since we are not interested in the value of different stock options, but in the value between two different stock prices, in option methodology, we are creating bull call spreads, and we have to value these bull call spreads, and then we will can assign value to different equity classes. So what is the bull call spread? In principle, what we are doing, we are buying a long call. We were buying a call with the lowest strike price, and we are selling the short call. We are selling the call with the higher strike price. So this is the area. This is the area where we can participate when the equity is going up, but this the amount who would participate is limited. You will see in a moment why it is so important, because in the OPM Backsolve valuation method, in principle, we try to create a chain of these bull call spreads in order to value the different classes of equity. We will before I continue on the very how we value these different rights. I think it is most important to look at how option pricing looks like. So we have the option formula. We value, let's say, option price with the strike price of 10. We have the initial price of 100, then we have how long the option is running, volatility rate, interest, dividend is normally startups don't pay any dividends, so therefore we assume here 0, but interest rate. Based on this assumption, Black-Scholes formula tells us that this option has the value of 91.81. I speak now about the option for a stock price, but what we are doing in the OPM method, we understand this 100 not as the option value of the current stock price, but current enterprise value. So we are assuming that the current enterprise value is 100. If the current enterprise value is 100, and we have the breakpoint or strike price at 10 million, what is the value of the option which start at 10 and go it start at 10? What the value of this option is, or how much you would have to pay for this? According to the Black-Scholes, it will be 1 million. So when we what the option allows us, what the option pricing allows us to create different ranges with different strike prices, we can see how much value is assigned to every the model assigns to every strike price, because practically we have the current price of 100. Where the option will be where the price will be in 5 years, nobody knows. But we try to in the model, the possibility of change of the price, it can go up or down, is volatility, 30% of the volatility. So the volatility tells us probability, or we have the probabilistic function now, which can obtain different potential values, and based on these potential values, model calculates the current value of the in this case, of the strike price of 10 or breakpoint of 10 million. Very important in the model, the probabilistic model, as Black-Scholes is. Black-Scholes model doesn't assume that he knows where the stock price will be in 5 years. No, nobody knows that, but it is the probability will be calculated according to potential change, which is expressed in the measure of volatility, which market has to make assumption how the company or similar companies can change in this time period. Values of this company can change. So it is very important to obtain volatility rate, which is quite realistic. So what we are doing now, what I am wanting to show, when we have the option, when we have the strike price of 10, the volatility of 30, and now volatility of 50, we increase volatility to 50%. The value of this option almost doesn't change. But if we have the out of the money option, or let's say here is a potential shareholder, he will start to participate on the value of the company if the equity is at least 110 million. Everything before he don't participate. He has, for example, employees option, which starts with the strike price, which is substantial. It is higher than today's current value. So its option has to increase. We start here with 30%. This kind of option has today the value not 91 but only $30. But if we change the volatility, I said before, option price was almost the same, but when we assume volatility of 50%, option price increases from 30 to 45. So in the model what we will use, or we use now to value the companies, the impact of volatility is higher for the rights which obtain some rights to the profits of the company later, or when the potential prices are already higher. So this is my preparation, or I try to explain why the value of option pricing is the right way to do it, and why the different volatility assumptions, with what kind of impact they have on the value of different instruments. Before I continue now with the explanation of the method, I would like to mention another value, so-called exit value, because it is quite often when I discuss with customers, according to the OPM, the value is this, but if I calculate the exit value, the value is totally different. Exit value is has totally different viewpoint. The OPM is a probabilistic value estimated according to Black-Scholes model. And exit value assumes that the future value of the company is as the current value, which we are using in our model to calculate values of the different equity classes. But then is no potential to any increase or any chance that the value of the company will change. We just say, okay, when the value is 100, how much is the value of class A, class B, class C, without any probabilistic assumptions, as the OPM is assuming, when the OPM is assuming that is potential that the value will change substantially in the future. When we work with the OPM, the biggest, one of the most important instrument what we have is our capitalization table. Every company should have the capitalization table, which shows what kind of equity classes are in the company, to whom the company belong, or to whom it can potentially belong at the fully converted basis. So here I have created this very relatively simple company, or simple capitalization table, which has the class A, class B, common shares, and warrants. So what we have, the class A is invested 1 million, has the liquidation preference of 1, so and conversion rate of 2. So means that if they convert, they will convert this 1 million which they invested in 500,000 shares. When they will convert, they will not convert right from the beginning. At least when the company has the higher value than their liquidation preference, that they obtain from the shareholding more than they would obtain from the liquidation preference. When we have the class B, is this 1.5 million invested. They have also liquidation preference from 1 and conversion rates from 5. So when they convert, they will convert 300,000 into 300,000 shares. And then we have the common shares, is 1.5 million common shares. And we have also 10 warrants, which will have the warrant price of 10. So conversion capitalization table shows us then also the on the fully converted basis to whom the company will belong. So if this when everybody converts and everybody let's say company has value of 100 million, then we have fully converted is the class A 20%, class B 12%, common shares 59%, and 10% belongs to warrants. Also very important information what what capitalization table tells us is that class A and class B has the pari passu status, so they both are treated equally. With this information, and potentially we need some documents which describe more in detail investment of class A and B, we can start to create our breakpoints which we need which we need in order to be able to use option price methodology to value this company. So with the help of cap table and additional legal documents which describe the rights and privileges of different equity classes, we can create breakpoints. Yeah, shareholders of class A preferred invest 1 million, and shareholders of class B invested 1.5 million. Their liquidation preference multiple is 1, so the first 2.5 million of profits of value in case of liquidation or sale will be distributed to them. 2.5 million is the first breakpoint. Profit and values are distributed. Now I think I can better show this using this table. So we have the first breakpoints at 2.5 million when the company has only the value of 2.5, 1 million go to class A, and 1.5 million goes to class B. So the split is pari passu, 40-60%. Then they invest two in class A and class B. They didn't convert it into shares yet, so they will not do it as long they don't see potential that there is more equity in the company and it's worthy for them to do it, because when they convert they lose their preferred status. So next profit above 2.5 million goes 100% to common shares. But when the company reach the value of 5.5 million, this is the point when the class A say yeah, now I want to convert. Why? Okay, assume 5.5 million. It is a level at which the class A is still indifferent. Convert or take the money under their liquidation preference right. If it is 5.5 million, 1.5 goes to goes to class B. The remaining 4 million, if class A decides to convert, they obtain now 500,000 shares. Common shares are 1,500,000. So altogether is 2 million shares, and then it goes in the 25% to class A and 75% to common shares. Class A obtains also 1 million as it would obtain under liquidation preference status. But it is now is the break even. Any dollar above 5.5 million, they will obtain more from shareholding than from liquidation preference. So this 5.5 is starting point when they say, yes, I want to convert. And now for class B, it's still not worthy to convert because they are converting in only 300,000 shares at price of 5, so they still prefer the profit of the company is less than 11.5 million to stay with their liquidation preference and don't assume their shareholding rights. But this creates now the next breakpoint of 11.5 million, when from them now the profit will be of the company from 11.5 million will distributed between class A, class B 13%, and common share 65%. In our example, the next breakpoint, when we have the warrants with the price of 10, so when the share prices are 10, in this calculation it corresponds to 23 million. At 23 million, they will come also into play, so they will as well start to profit from the exercises their warrant rights and convert this into shareholding. And for any dollar above 23, this is also what we called at the beginning at the fully converted basis. So we have created ranges between different value of equity, and we know from what I said before from the option pricing that at the different options with different strike prices have different values. So now we can use this together in order to value the different classes, and we will have to as many breakpoints as necessary when the marginal distribution of the profits for any of these classes will change. So it can be substantially more breakpoints than we have shown here, but it's no problem. We can assign this easily to assign the calculate strike prices or breakpoints, calculate option prices based on this. So let's start from we have the model. We have a breakpoints, we have the value of the company at what we assume. We have calculated this with different means. When we assume the value of the company is 8.4 million, we have assumed information about we are doing the company will exist for next 5 years. We have volatility of 30%, we have risk-free rate of 4%, and dividends are 0. When we start to value this the strike price of a breakpoint of 0, the value of the option with zero is the same as the current equity or current stock price. So it is the value of the option. Now, but we are interested in the, as I said, in the option terms, we are interested in bull call spreads, and the first spread is when we assign this here as the difference is the value which we can assign in this range. The value is 2.2 million, and this value will be assigned 30% to class A and 60% to class B, resulting then when we split this value into amounts which will be later added to calculate the value of class A and class B preferred. The next breakpoint tells us, okay, in the next breakpoint is the breakpoint when liquidation preference is still valid, but A and B didn't convert it into common shares. So we see 100% of value which is created in this range is assigned to common shares. So the common shares obtain the full participation in this range. But then we have the range when the class A converted, when we have the class B converted, and the rest when we have also warrants. When we obtained this calculated with different values, we can then calculate the total value it is shown now in yellow of these different classes. And this is the value which we can only establish according with the method which is assumed as the right model for to establish the probabilistic value, because nobody knows what will be value in 5 years of this company. But if we have assumed the right assumptions, especially about the volatility, we have assigned the value correctly to these different classes. Where this model is also very important, why it is used. It is especially when we want to know we have the recent transaction in the company. Let's say class B is right now decided to invest the money into the company and invested 1.5 million. So we could do the following calculation. If we assume the value of the class B preferred of 1.5 million, it is the market transaction which was just executed. We can use our model. In Excel is still very simple. We use the function of goal seek. We start we start with we assign the value of 1.5 million to the class A preferred, and we'll ask model to change this cell with the current price of equity in order that it works together with 1.5 million. And we have it. So we have now, with help of our OPM method, we establish the current value of all classes according to the market transaction based on the last transaction in the equity of this company. So if we want to value, for example, new options which we grant to the employees, we know the value of these options because we have the market transaction in the equity of the company, which is relatively new, and it is where something is not theoretical value, but somebody paid so much money or they invested so much money in order to get the possibility to participate in future in the profits of in the equity of the company. So this is a model what could be used both ways to reassign the value of the equity when we know into different classes of equity, or if we know the one transaction in one of the classes, then we can go back and calculate implied value of the equity, which works with this model. Oh, this is in principle what I had to say. I think it is very interesting way, or very interesting area where we can use our Backsolve methodology to calculate the value of the startup. As we conclude our exploration of equity valuation methodologies in the empire of early-stage enterprises, the intricate interplay of rights, preferences, and valuation intricacies becomes apparent. The OPM Backsolve method emerges not just as a tool, but as a beacon, guiding us through the labyrinth of equity classes. Understanding the complexity and nuances of valuation, especially in early-stage enterprises, is vital. The OPM method, which is with its ability to dissect, evaluate, and allocate value among diverse equity classes, offers a clearer lens to comprehend the true worth of each shareholder's position. Equip the OPM Backsolve method in your toolkit. You gain a decisive advantage in negotiating new investments or financing, amplifying your leverage and insight. I hope you learned something and you liked my presentation, and maybe we'll see us in the future at a different topic. Thank you very much. Bye.